Investing is a long game. Whether you want to invest for retirement or grow your savings, when you put money to work in markets, it's best to set it and forget it. But successful long-term investing isn't as simple as just throwing money at the stock market. Here are 7 tips for long-term investments. 1. Get your finances in order. Before you can invest for the long term, you need to know how much money you have to invest. That means getting your finances in order. Just like a doctor wouldn't write you a prescription without diagnosing you first, an investment portfolio shouldn't be recommended until a client has gone through a comprehensive financial planning process, says Taylor Schultz, a San Diego-based certified financial planner and host of the Stay Wealthy podcast. Start by taking stock of your assets and debts, setting up a reasonable debt management plan, and understanding how much you need to fully stock an emergency fund. Tackling these financial tasks first ensures that you'll be able to put funds into long-term investments and not need to pull money out again for a while. Withdrawing funds early from long-term investments undercuts your goals, may force you to sell at a loss, and can have potentially expensive tax implications. 2. Know your time horizon. Everyone has different investing goals: retirement, paying for your children's college education, building up a home down payment. No matter what the goal, the key to all long-term investing is understanding your time horizon, or how many years before you need the money. Typically, long-term investing means 5 years or more, but there's no firm definition. By understanding when you need the funds you're investing, you will have a better sense of appropriate investments to choose and how much risk you should take on. For example, Dorinda King, a CFP with Urban Wealth Management in El Segundo, California, suggests that if someone is investing in a college fund for a child who is 18 years away from being a student, they can afford to take on more risk. They may be able to invest more aggressively because their portfolio has more time to recover from market volatility, she says. 3. Pick a strategy and stick with it. Once you've established your investing goals and time horizon, choose an investing strategy and stick with it. It may even be helpful to break your overall time horizon into narrower segments to guide your choice of asset allocation. Stacy Francis, president and CEO of Francis Financial in New York City, divvies long-term investing into 3 different buckets, based on the target date of your goal: 5 to 15 years away, 15 to 30 years away, and more than 30 years away. The shortest timeline should be the most conservatively invested with, Francis suggests, a portfolio of 50 to 60% in stocks and the rest in bonds. 4. Understand investing risks. To avoid knee-jerk reactions to market dips, be sure you know the risks inherent in investing in different assets before you buy them. Stocks are typically considered riskier investments than bonds, for instance. That's why Francis suggests trimming your stock allocation as you approach your goal. This way you can lock in some of your gains as you reach your deadline. But even within the category of stocks, some investments are riskier than others. For example, U.S. stocks are thought to be safer than stocks from countries with still developing economies because of the usually greater economic and political uncertainties in those regions. Bonds can be less risky, but they're not 100% safe. For example, corporate bonds are only as secure as the issuer's bottom line. If the firm goes bankrupt, it may not be able to repay its debts, and bondholders would have to take the loss. To minimize this default risk, you should stick with investing in bonds from companies with high credit ratings. Assessing risk is not always as simple as looking at credit ratings, however. Investors must also consider their own risk tolerance, or how much risk they're able to stomach. 5. Diversify well for successful long-term investing. Spreading your portfolio across a variety of assets allows you to hedge your bets and boost the odds you're holding a winner at any given time over your long investing time frame. We don't want 2 or more investments that are highly correlated and moving in the same direction, Schultz says. We want our investments to move in different directions, the definition of diversification. Mind the costs of investing. Investing costs can eat into your gains and feed into your losses. When you invest, you generally have 2 main fees to keep in mind: the expense ratio of the funds you invest in and any management fees advisors charge. In the past, you also had to pay for trading fees each time you bought individual stocks, ETFs, or mutual funds, but these are much less common now. Fund expense ratios. When it comes to investing in mutual funds and ETFs, you have to pay an annual expense ratio, which is what it costs to run a fund each year. These are usually expressed as a percentage of the total assets you hold with a fund. Schultz suggests seeking investments with expense ratios below 0.25% a year. Some funds might also add sales charges, also called front-end or back-end loads, depending on whether they're charged when you buy or sell, surrender charges, if you sell before a specified time frame, or both. If you're looking to invest with low-cost index funds, you can generally avoid these kinds of fees. Financial advisory fees. If you receive advice on your financial and investment decisions, you may incur more charges. Financial advisors, who can offer in-depth guidance on a range of money matters, often charge an annual management fee, expressed as a percentage of the value of the assets you hold with them. This is typically 1 to 2% a year. Robo-advisors are a more affordable option, at 0% to 0.25% of the assets they hold for you, but they tend to offer a more limited number of services and investment options. Long-term impact of fees. Though any of these investing costs might seem small independently, they compound immensely over time. Consider if you invested $100,000 over 20 years. Assuming a 4% annual return, paying 1% in annual fees leaves you with almost $30,000 less than if you'd kept your costs down to 0.25% in annual fees, according to the U.S. Securities and Exchange Commission. If you'd been able to leave that sum invested, with the same 4% annual return, you'd have earned an extra $12,000, meaning you would have over $40,000 more with the lower cost investments. 7. Review your strategy regularly. Even though you've committed to sticking with your investing strategy, you still need to check in periodically and make adjustments. Frances and her team of analysts do an in-depth review of their clients' portfolios and their underlying assets on a quarterly basis. You can do the same with your portfolio. While you may not need to check in quarterly if you're passively investing in index funds, most advisors recommend at least an annual check-in. When you check up on your portfolio, you want to make sure your allocations are still on target. In hot markets, stocks might quickly outgrow their intended portion of your portfolio, for example, and need to be pared back. If you don't update your holdings, you might end up taking on more or less of risk with your money than you intend, which carries risks of its own. That's why regular rebalancing is an important part of sticking with your strategy. You might also double-check your holdings to ensure they're still performing as expected. Frances recently discovered a bond fund in some clients' portfolios that had veered from its stated investment objective and boosted returns by investing in junk bonds, which have the lowest credit ratings, making them the riskiest of bonds. That was more risk than they were looking for in their bond allocation, so she dumped it. Look for changes in your own situation, too. A financial plan is a living, breathing document, Schultz says. Things can change quickly in a client's life, so it's important to have those review meetings periodically to be sure a change in their situation doesn't prompt a change with how their money is being invested. The final word on long-term investing. Overall, investing is all about focusing on your financial goals and ignoring the busybody nature of the markets and the media that covers them. That means buying and holding for the long haul, regardless of any news that might move you to try and time the market. If you found this video helpful, make sure to give this video a like and subscribe to the channel as we provide the best in the financial space.